case, in Europe, it has shifted from one pole to another. At times, public debt has been seen as both too safe and too risky. And we've moved from one extreme to the other in different places and at different points in time. Debt has been seen as too safe because the widespread belief that before the crisis, that the debt of different euro area sovereigns was interchangeable, fueled an unwarranted compression of interest rate differences, interest rate spreads, and contributed to major financial and macroeconomic imbalances. So debt was too safe in this respect. But debt was also too risky because with the rapid unwinding of those beliefs has cascaded through the financial system and government, pushing the Eurozone into a deeper and more prolonged crisis than any other advanced economy. And that's also because debt was too risky. Mm-hmm. So debt has been both too safe and too risky. And even today, there is a rift in Europe between those economists and those politicians who want public debt to be safe again or safer, and those who want it to be riskier or risky again. And that's one of the big rifts we see in the European discussion today, both in the economic universe and also in the political universe. And looking forward, neither extreme is sustainable. We need public debt to be safe in the Eurozone. Debt is vital to the functioning of the financial system, just like money in the real economy. It allows governments to play their proper role in stabilizing economies, which is essential in the institutional design of the monetary union, that governments can use debt to stabilize their economies. If sovereign debt is too risky, it will place the full burden of economic stabilization on other actors, and it will place the full burden on other actors to provide safe assets, safe financial assets for the functioning of the economy and for economic stabilization. And that's ultimately also potentially a danger for money. Unsustainable fiscal policy can ultimately create pressure on the central bank to monetize debt, which economists call fiscal dominance. Even in a fiat money system where there is no direct link anymore between money and government finance, there is at least a perception that an impaired creditworthiness of governments will ultimately create the risk of eroding trust in the currency, which is the ultimate safe asset. So at the end, if we let this process of debt becoming too risky goes to its end, at the end also confidence in money can be eroded. So you can understand why it's an issue for me as an ECB representative. That would eliminate the role of what we call market discipline, which is investors putting a price on debt in delivering sustainable policies, and it would create a false belief that governments cannot fail. But governments can fail, and we've seen that. However well-designed the fiscal rules in Europe, our political systems cannot credibly deliver the promise that government will never default on their debts, because always and in all places and always in all economies, governments have defaulted. So that would be a false promise to explain that governments will never default. That's just not possible. Unless, there is a caveat here, unless there would be a commitment by the central bank to bail out governments no matter what. But that's something that the treaties establishing the Eurozone have formally excluded. So, at this point, the message is debt can neither be too risky nor too safe. So let me elaborate a little bit on the different dimensions. But first, let me start with considerations on what's a safe asset. What do we mean by safety in finance? What's the fundamental difference between a safe asset and a risky asset? So the way economists would look at it is to look at how financial assets behave in financial crisis. The price of safe assets correlate negatively with risk aversion, which in plain English means that in a crisis you want to buy it, and the price goes up, right? So in a financial crisis, the demand for safe asset goes up, while the demand for all other assets goes down. And that's the difference between a safe asset and a risky asset. And the opposite for risky assets. And why is that so? That's because they contain Safe assets contains no uncertainty about future payments, which means that holders of safe assets have no reason to pass judgments on the probability of default over time. They feel comfortable with holding the asset even in a crisis. So many have pointed out that that definition is partly self-referential. In the end, assets are just as safe as they are expected to be. And as a consequence, they are prone to abrupt shifts in confidence. There are ways to strengthen the perception of safety. You can, and here I borrow from a nice article by Anna Gelpern, who was just out in the Yale Journal of Regulation, where she says there are ways to secure the safety of assets. You can make assets safer by improving the quality of their fundamentals, making it more likely that they will be repaid. You can guarantee the safety, so the government can extend a guarantee, for instance, which is also a way to make assets safer. And you have something slightly different, which is labeling. You can label assets as safe. That's what credit rating agencies are doing by giving AAA, AA, single A ratings. That's also what regulators are doing by putting assets in different buckets and saying that some assets are high-quality liquid assets, for instance, which banking regulators are doing, which is also labeling. Well, of course, that labeling option is less convincing. We've seen in the crisis that credit rating agencies have failed in rating structured products, for instance. So they've given a false sense of safety. But still, there are ways to strengthen confidence in the safety of assets. But another important message here is that safety is not an intrinsic property of a given financial asset. It's also the outcome of an institutional and a legal framework, because safety is also strengthened by or created by legal protection. So it's also a political construction. In most advanced economies, the institutional framework and the legal framework has been designed to ensure that certain types of assets are always perceived as safe because they are important for the functioning of the economy. That's obvious in the case of money. Central bank money, base money, cash, is a safe asset. Nobody would challenge that, except in very extreme cases. And here safety is guaranteed by two factors: trust in the central bank, that protects the value of the money, but also trust in the rule of law, security of contracts, the fairness of the judicial process, and so on, which backs the central bank and the economic transactions that are underpinning the stability of money. And these institutions help us understand also why, in the case of the Eurozone, even as trust in European governments has clearly eroded in the crisis, trust in the euro as a currency has remained high across the Union and even beyond the Union, for instance, for institutional investors who have kept their holdings of euros. Just to give you a few numbers, there is this Eurobarometer where the European Commission surveys European citizens, and according to the latest numbers, 27% of European citizens trust their own government, which is not a lot, 27. 33% trust the European Union, which is slightly better. Support for the euro is 68%. So that's also maybe a paradox or a mystery. Why is there so much confidence in the euro while the institutions underpinning the euro are not trusted? So that's also one of the questions I wanted to throw in the discussion. And one answer is European citizens don't trust that much their governments. They don't fully trust the ECB also from these numbers, but they trust the legal underpinnings, they trust the legal contract and maybe the social contract which is underlying the European Union and the monetary union. So they trust Europe as a legal construction. So that's for central bank money. The same kind of logic can apply to private money, private bank money. States have ensured the safety of bank money, that is money created by banks, by guaranteeing the share which is the most relevant for transactions, and that's called deposit insurance that we have everywhere. We have it in the US with the FDIC, and we also have it in Europe, in all countries through European regulations, up to 100,000 euros. And in exchange for deposit insurance, they hold banks to a contract, a social contract, through a high degree of supervision and regulation. So banks are bound by supervision, regulation, to ensure the safeness of the money they are creating. What we've learned in the Eurozone, however, is that this contract between the society and banks depends on a uniform institutional framework, which we didn't have in the Eurozone. Otherwise, bank money can be fragmented, is liable to fragment. And Europe responded to that and created banking union, which is a way to ensure the uniformity of the framework applying to bank money, which is also a way to ensure the safeness of private money. And Hans Helmut, who's here, has written about that, about the importance of banking union in our particular setup where we have a money without a state. And then moving to government debt, in most advanced economies also, government debt is always perceived to be safe. There is de facto full consolidation between the balance sheet of the central bank and the balance sheet of the fiscal authority, which makes government debt risk-free in nominal terms. The central bank can guarantee its payment in cash and at par in all states of the world. And as such, there is no credit risk attached to sovereign bonds. There may be an inflation risk. So there's still a way to default on government debt, which is inflation, which is another way to default on debt. So there is an inflation risk, but there is no credit risk, because there is no concern that government debt will not be reimbursed. And look at the US, for instance, the federal government has been downgraded by credit rating agencies. That doesn't seem to matter much for the economy. That's because nobody actually envisages that the federal government could default. But in the Eurozone, the same institutional relationships do not apply. So that's where we're starting to see a difference between European debt and debt outside of Europe. We have, as you know very well, we have one central bank and 19 different fiscal authorities. The member countries do not assume responsibilities for each other's debt. This is forbidden under the EU treaty. The ECB, for very good reasons in my view, I will explain why, is forbidden by the treaty from monetary financing, which is directly financing governments or directly purchasing the debt issued by governments. Why is that so? That's because we don't want fiscal transfers to take place through the central bank when they've not been authorized by euro area citizens. So we don't want the central bank to perform fiscal functions which would have to be validated by elected governments and parliaments. And also it avoids dominance of fiscal policy over monetary policy, which would threaten price stability. So that's for good reasons in my view, and that's what we have in the EU treaties. But it also means that Eurozone government bonds are, in a sense, equivalent to sub-sovereign issues. So they are more like bonds issued by US states than bonds issued by the US federal government, if you want to take the comparison. And that's because the different fiscal authorities and the central bank can't be consolidated within a single federal balance sheet. That's not the way it works in the Eurozone. German bonds, Greek bonds are not guaranteed by any European authority, just as bonds issued by California or by Arkansas are not guaranteed by the federal government or by the Federal Reserve. So, well, now you're going to tell me, yeah, but we have now the European Stability Mechanism, which is a way to provide a backstop to governments as a permanent crisis resolution mechanism. That is true, and that is huge progress. It is a backstop for national budgets, but it is limited in size. So it's not unlimited. It's conditional on countries accepting an adjustment program. And it's not a federal institution, it is an intergovernmental institution. And as you know, legally it's not in the EU treaties, it's a separate treaty. It's not under community law, it's a standalone mechanism. So it cannot be compared to a federal fiscal backup. So the conclusion is that sovereign debt in the Eurozone is exposed to credit risk in a way that other advanced economies are not. And that's a reason to worry about it. And that's by design. So it's not by chance. It's by design. It's accepted, and it was actually planned, designed by the authors of the EU treaties. The whole construction of the Eurozone, including the prohibition of monetary financing, which I mentioned, including the no bailout clause, whereby governments cannot support each other, is deliberately intended to encourage markets to differentiate between euro area sovereigns based on their fiscal sustainability. So that's by design. And the idea here is that the exercise of market discipline will provide a continuous assessment of government action, which in turn will lead to better policies. So I will qualify it in a moment. But before qualifying, let me say that it is necessary because in a monetary union, unsound national fiscal policies, unsustainable fiscal policies do have spillovers to other countries, and they do have spillovers to the central bank. So they have spillovers to other countries directly and also indirectly through monetary policy. Ensuring against that risk across countries would entail a degree of shared sovereignty, which the European people so far are not willing to concede, and even less and less in a sense. This also we can discuss. So decision-making on fiscal policies in the Eurozone is decentralized among sovereign states. It's guided by a set of fiscal rules, the Stability and Growth Pact, which the center, that is the European Commission, the Council of Ministers, have only limited power to enforce. So it's mostly decentralized. So the consequence of that setup we have in Europe is that just as for states in the US with their balanced budget rules, well, not all of them, but most of them, the possibility that creditors might take losses is crucial to the credibility of the fiscal framework we have in Europe. Or to put it another way, it's important that debt is not too safe in Europe, meaning that losses would be excluded. Otherwise, the full burden for ensuring fiscal sustainability would end up on the fiscal rules, which we've seen are not so credible by experience. Or, alternatively, they would rest on the expectation that the central bank eventually will bail out governments, which, as I said, is forbidden by the EU treaties. So euro area sovereigns are exposed to credit risk, which doesn't mean, in principle, that they cannot also issue safe assets. So the fact that government bonds are exposed to credit risk more than in any other place doesn't mean that they cannot serve as safe assets. But the difference is that they have to be made safe. They cannot be assumed safe, contrary to most other places. And it is clear from the structure of Eurozone government bond yields, even today, that credit risk is partly responsive to the outcome of fiscal policies. Yet, so now I'm qualifying a little bit the virtues of that framework. We've also seen in the Eurozone and throughout the crisis that sound fiscal policies alone are not sufficient to make sovereign bonds safe. So the notion that if you have good fiscal rules or if governments are virtuous and deliver good fiscal policy, then everything will be fine and debt will be safe, that hasn't worked. Why is that so? Because market discipline is not perfect. In many cases, market discipline just doesn't work. Because of the inherent features of financial markets. Credit risk premia do not increase in a continuous way, which would lead to endogenously to better fiscal and economic policies. They are very nonlinear. Credit risk is underpriced in good times when risk aversion is low, and it's rapidly repriced in bad times when risk aversion spikes. And this results in a lot of price volatility also on these debt markets. So the market mechanism here is very imperfect. It doesn't work very well. And when such nonlinearities do arise, it may also be self-fulfilling. So it may lead to what economists call multiple equilibria. That is, throwing a country into a financial crisis, even when fiscal policy was right. And it's very difficult empirically to know from the facts whether this is self-fulfilling or whether this is driven by fundamentals. That's the difficulty we face throughout the crisis. So you can have virtuous circles. And indeed, looking at the whole sequence of the crisis, at the start of the crisis, 8 Eurozone governments had AAA sovereign rating, which is the best possible sovereign rating. Today, only 3 have this status. So market discipline has not created safe assets. Market discipline has destroyed safe assets, actually. We have less safe assets today than initially because of these market mechanisms. One response, which is now passionately discussed, I would say fiercely discussed in Europe, is to apply regulatory constraints or risk weights to sovereign bonds to acknowledge the riskiness of sovereign bonds, meaning that banks, for instance, could not weight the risk attached to sovereign bonds to 0, but they would have to put a number on it to account for the riskiness of their holdings of sovereign bonds. And that's a big discussion we're having in Europe. And that's a way to encourage banks, pension funds, insurers to consider the risk of default of sovereigns, which today we don't have, because today it is 0. So in principle, that would make market discipline more effective. And if coupled with proposals for mechanisms for orderly sovereign default, this might help attenuate the severity of crisis. But it cannot be a full solution. It's quite obvious that it would also reduce the ability of domestic banks to act as a backstop, to act as a contingency liquidity buffer to governments. So it may leave government bond markets even at more risk of multiple equilibria, because banks would cease playing that role of stabilizers that they today play. And if there is no additional fiscal backing, sovereign yields might increase even more in times of financial stress if we move to this new regime. So however desirable from a prudential perspective, I think it is desirable from a prudential perspective. It's good to protect banks from excessive risk coming from governments. But it seems quite odd to discuss this proposal without considering the fiscal consequences, which is the way it is discussed today in Europe from a pure prudential angle. So taken in isolation, such proposals are not likely to resolve the tension between market discipline on the one hand and safe assets on the other hand. And this is very important. It's very important because sovereign debt provides a safe asset for the financial system. The financial system is increasingly dependent on a sufficient supply of safe assets, even more than yesterday. And if governments are not supplying the safe assets to the financial system, somebody else has to do it. And it's also important because sovereign debt is a safe liability for governments. So it matters for markets, but it also matters for governments, because that's the way through which governments stabilize the economy, by issuing debt. If governments are unable to perform this role of issuing bonds to stabilize the economy, there will be insufficient stabilization at the national level, and by implication, there will be insufficient stabilization at the level of the Eurozone as a whole. So that situation matters in two ways. It matters because government bonds are safe assets. It matters because government bonds are safe liabilities. Or it matters for markets, and it matters for governments. So let me take the two sides, the two aspects in turn. First, sovereign debt as a safe asset for market functioning. Safe assets performs two vital roles in the system, which make them a very close substitute to money. So coming back to the three functions of money, store of value, means of exchange, and unit of account. A government bond cannot be a unit of account. That's for sure. Nobody counts using government bonds. Government bonds are denominated in currency. So this they can't do. But government bonds are stores of value. I mean, insurance companies, mutual funds hold a lot of government bonds as store of value. And government bonds also as our means of exchange. It's a way to settle transactions. So these are two key functions of money that government bonds are playing. So there is a continuum between money and debt to this respect. First, government bonds as a store of value. That's key for pension funds, insurance companies, more generally for meeting regulatory requirements. So as you may know, banks now have to hold liquidity buffers. They are bound by regulation to meet certain liquidity standards, and they have to be invested partly in very liquid assets, which usually are government bonds, T-bills, T-bonds, and the like. And that demand has increased significantly in the new regulatory framework. So there is an increasing demand for these kind of safe assets for the financial industry to be safer. And government bonds are also means of exchange. especially for the non-bank financial system, which cannot settle claims in central bank money. Banks can create money, and they can borrow money from the central bank. So they can settle their transactions in central bank money. Non-banks cannot do that. So they have to use private money, which is partly T-bills and T-bonds as well. Plus, recently we've seen a trend towards collateralized lending, meaning that you don't lend to, when you extend a loan, you don't lend, you need to secure your lending, so you need a collateral to secure the lending. Money markets used to work very much on an uncollateralized basis, no longer. And so now even for very short-term transactions, you need collateral. And what's the collateral? Usually it's a government bond. So that's typically money as a government bonds as a means of exchange. And again, on that side, the demand for government bonds, safe assets, is increasing very, very sharply. Also because financial intermediation is shifting from the banking sector to the non-banking sector, which creates many regulatory challenges. But one direct consequence is this increased demand for safe assets. So if the net supply of safe sovereign bonds suddenly contracts, which is what we've seen in the Eurozone, it can be extremely disruptive for the functioning of the financial system. It's exactly analogous to expansions and contractions in the supply of cash. So it is analogous to monetary contraction whenever there is a contraction in the supply of safe assets. So that's something we have to be sensitive to. All central banks, including the ECB, have responded to that reduction in safe assets during the crisis by swapping central bank money for assets with duration risk and credit risk. So we've stepped in to provide central bank money to substitute for the shortage of safe assets. And because we have this ability to create central bank reserves which are without debt considered as safe. So we've done that. We've done that because stabilizing money is what central banks are for, and the Federal Reserve also has done that. All central banks have done that, and we've done that because safe assets, being stores of value, being mediums of exchange, one can argue that they increasingly have moneyness. They are closer to money, so that's something central banks have to care for. But so we had to do it. We did it, but that's clearly not fully satisfying the demand for safe assets. In the Eurozone today, the demand for sovereign bonds provided by highly rated issuers remains very high. If you look at, for instance, at the price of borrowing in the market against the German Bund, it is very expensive. So you have evidence in market prices of scarcity of safe assets. And by contrast, borrowing against bonds issued by lower rated sovereigns has cheapened. So it also reflects a higher price of safety. So the price of safety is higher on the market. So the question is, who should take responsibility looking forward for increasing the supply of safe assets to meet this market demand? So there are different answers. One first answer, which should be quite obvious, is that governments should make their debt safer. So if governments run better fiscal policies, that would make the whole stock of government debt safer. And then some assets which today are not considered as very safe can be considered as safer, and again can be used as in financial transactions. That's about respecting the fiscal rules, but that's also about having fiscal policies which are more friendly to growth, friendlier to growth. Because if you think of debt sustainability in terms of the debt to GDP ratio, one thing is to lower debt, another thing is to increase GDP, obviously. So even for a given amount of deficit and debt, there are ways to make it more friendly to growth, say by shifting to public investment, education, universities, that's the right place to say that. Shifting the composition of budgets to make it friendlier to growth, which is also a way to make debt safer, because it will reassure investors on the ability of the government to reimburse debt eventually, because growth will be higher. There are other proposals. There are ways to generate safe assets out of the existing stock of debt. So, for instance, there is this proposal called the SBs, European Safe Bonds, ESB. Which Markus Brunner-Meyer and others have proposed, which doesn't require government intervention. It's a way to pool the existing stock of debt and then to tranche it to make assets safer out of the existing stock of debt. So you can use a little bit of financial technology here to produce safe assets. But then there is a third answer. If safe assets are not produced by governments, if they are not produced by markets, then of course also central banks can do it. There has been a fascinating and very intense discussion in Jackson Hole this year in August in the Kansas City Fed seminar on whether central banks should run permanently larger balance sheets to produce safe assets that financial markets can use. And Jeremy Steen here in Harvard has a paper on it. That would be a way for central banks to also to fill that gap left by the retrenchment, the withdrawal of safe assets from financial markets. And that's something that to some extent we are seeing already. The Fed, for instance, now allows money market funds to access its balance sheet. The reverse repo operations of the Fed can be used by money market funds. The Bank of England grants access to clearinghouses, CCPs. There are different ways. I'm not going to go into the details, but there are different ways for central banks to do that. Something we are doing in Europe, for instance, is that, as you know, we have QE. We are buying lots of government bonds as part of our monetary policy. We are re-lending these bonds to the market. So the bonds we've purchased from the market, we are lending them out to investors to alleviate the scarcity of safe assets. Because any bond we buy, of course, is withdrawn from the market, but then we can re-lend it so that it can be used in different kinds of transactions, which is also a way for us to step in. So it is in we have the operational capacity to do that, but of course, in our view, it cannot be a first best solution because it would suppress a crucial incentive for governments to improve the safety of their debt. So we, as central bankers, we very much believe that the first best solution is for governments to make their debt safer before we have to step in. So that was for debt as a safe asset. And finally, let me move to debt as a safe liability. So I move back to the government side and the government viewpoint. Everything I've just described, central bank operations, synthetic bonds produced in the market, that might be able to meet demand for safe assets, but it cannot replicate another vital function of sovereign bonds, which is to provide safe liabilities for governments. So none of these two options would shield governments from the type of distortions in sovereign bond markets that I've described. That is, governments losing access to market, facing elevated spreads in markets, which would prevent them from performing their stabilization role in the economy. And this matters a lot because governments must have recourse to their own liabilities, that is, issuing debt, to stabilize their economies through downswings in the cycle. If instead sovereign debt becomes cheaper in a downturn, then the cost of borrowing increases precisely when you need it, which is very procyclical. So it constrains a lot the ability of governments to stabilize the economy. If when you have to issue more debt, it becomes more difficult for you to do it. That's particularly relevant for the Eurozone, given the institutional setup I've described, that we have a vital need for governments, national governments, to be able to perform stabilization because there is no federal budget. We don't have joint instruments to absorb shocks like a federal budget. So monetary policy can do it to some extent, but monetary policy is single. We focus on the Eurozone. We cannot deal with local shocks. Or, to be more precise, we can deal with local shocks, but only insofar as they have a proven impact on monetary policy. So, for instance, we have this OMT program, outright monetary transactions, which we've created in 2012, which is a way to intervene on debt markets in given countries at a local level, but it has to be, we have to see the distortion to monetary policy, and we made it conditional to countries being under an ESM program, being under an adjustment program, because we don't want to pass a judgment on the policies being undertaken in the country. So we want to defer to political bodies when it comes to the adjustment program. because we feel it's not our job to do it. So what we can do to address local shocks is limited. That's the message. And so we need governments to be in a position to do stabilization at the local level. So there are different ways to stabilize economies at a local level, to absorb shock, as economists like to say. It doesn't have to be through governments, by the way. It can be through markets. And there is a well-known literature that compares the US and Europe and compares the degree of shock absorption through capital markets compared to shock absorption through budgets, governments. And the Capital Market Union project, which the European Commission has launched, is one way to do it, to deepen capital markets in Europe, to deepen cross-border capital flows, in particular cross-border equity flows, to make so that economies would be better resilient to shocks and there would be less need for governments to do it. So part of the absorption of shocks can be in the private economy, in markets. And that's important. But no one really imagines that we can live in a world where this kind of absorption of shocks, this kind of risk sharing, would absorb all shocks. So there will always be a need for governments to deal with economic cycles, business cycles, and financial cycles. So the capacity to use fiscal policy in a counter-cyclical way is key, which means that governments must have access to some form of safe assets in times of crisis. Otherwise, debt issuance will be destabilizing because you will issue more debt at a time where the cost of debt is higher. And this can feed back into the economy, feed back into the financial system in destabilizing ways. Mm-hmm. So how can we guarantee that sovereigns retain market access while preserving the market discipline, which I've said is needed also in Europe? So again, the first obvious solution is governments improving their fiscal frameworks, doing better fiscal policy, so that debt issuance at the bottom of the cycle does not increase the perception of a credit risk, but is seen as supporting a faster return of the economy to full employment. So that's a message that is sometimes difficult to pass in Europe, that the respecting fiscal rules, abiding by the Stability and Growth Pact, is a way to restore the capacity of governments to support the economy. And if debt is unsustainable, governments lose their capacity to support the economy and to react to shocks. So that's the first thing. But now, to be realistic, we don't start from a blank slate. Debt levels are very high. So many governments in Europe are vulnerable to losing market access because of the legacy of the crisis. So we need some form of mutualization at the central level, which does not compromise market discipline. There are many proposals in the economic literature on how to do it, how to create a new form of fiscal stabilization in Europe. I see basically two possible models. The first model is, let me call it the US model. So we accept sovereign debt as risky, just as for US states. We accept that governments can default, just as US states can default. And we accept the risk premium that comes with it. We might even need at some point some kind of debt restructuring mechanism to be consistent with that model. But, that's an important but, in my view it's very unlikely that model would deliver the amount of fiscal space that is needed to stabilize the economy. Mm-hmm. So a purely decentralized model, which has been advocated by some, in my view, doesn't work because it would limit in a considerable way the capacity of governments to stabilize the economy. So if we want to come back to this model where there is fiscal responsibility, default, market discipline at local level, we have to allow the union to borrow and spend for fiscal stabilization. So we need a common fiscal capacity, which is the US model, by the way, which is at least for the last 100 years or so. Not for the first 100 years, but for the last 100 years. That fiscal capacity doesn't have to be very large. I don't want to discuss here the optimal size, but I'm not sure it would have to be very large if governments retain their ability to do it using their own budgets. It has merits, but it has to be created under the veil of ignorance, meaning that if you if you share fiscal risk, you have to do it in a way that where you don't know in advance to whom it will benefit. Otherwise, nobody will accept that. So it's if you want to create a new insurance mechanism, you need to do it under the veil of ignorance. So you need, prior to that discussion, you need some convergence across European economies. You need a convergence process to make economic structures more resilient and to make it less likely that some countries would always benefit from it while some other countries would pay. Because that would be what the Germans call the transfer union, which is not in the contract that created the euro. The monetary union is not a transfer union. There are transfer mechanisms in the EU, of course, structural funds, cohesion funds, and they are important. They could be increased, but that's not what monetary union is about. So the fiscal capacity that comes with monetary union cannot be a transfer mechanism. It has to be neutral ex ante. It has to be under the veil of ignorance. And today it's not possible because the economies are too different. So we will need some kind of transition process, convergence process if we want to get there, to have it politically accepted and to have it make sense from an economic standpoint. Of course, if we want to create that common fiscal capacity, we also need a shift towards joint decision making. So we need strong common institutions, and we need these institutions to be accountable to the European Parliament. It just doesn't make sense to create a fiscal capacity without democratic accountability. So there is a strong political dimensions to it. That's the first model. The second model, which also has been discussed in the economic literature, would be about splitting sovereign debt into a safe part and a risky part. So you have Bruegel in Brussels came with a blue bond, red bond proposal. Part of debt would be up to a certain level would be deemed safe, and above this level, you can still increase your debt level, but then it's junior to the first kind of debt. It can default, and it's riskier and it's more expensive. So you would have two kinds of debts, right? Well, senior debt and junior debt, blue debt, red debt. So it could be debt below 60% of GDP, above 60% of GDP, which is the Maastricht number, or could be any other scheme. But the notion here is to have a safe part and a risky part at national level as well. Which is, by the way, what private companies do, what banks do. You issue junior debt, senior debt, and you have a different price. So one important remark here is there are different possible models. Both models would, over time, increase the supply of safe assets, which comes to my previous point, but that's not primarily the point. Safe assets are a stock concept, so it's about the amount of assets that circulate in the economy. Safe liabilities are about the flow, that is the ability of governments to issue new debt to counter cyclical shocks. And that's an important difference. Another important feature of these two proposals is that both approaches to risk sharing, the common fiscal capacity, so the US model, and the blue bond, red bond proposal, both need to be underpinned by a set of rules at the Eurozone level, which would be mutually agreed and which would be enforced by common institutions. So none of this solution is a pure market solution. In all cases, you need institutions and you need them to be accountable to the European Parliament, and you need a common decision-making process. Which leads me exactly back to where I started. So I have closed the loop now and I conclude. I'm coming back to the other side of the coin. As I said, safe assets are only as safe as they are expected to be, and ultimately they are backed by legal and institutional commitments. So only adherence to a common political project centered on the euro can secure these kind of commitments in a sustainable manner. As long as the project is under strain, which is the case today, there is no wonder that the safety of assets will remain under questions. And I end with a quote which I always liked throughout my career, which is a quote by the Baron Louis, who was a finance minister of Louis XVIII, well, and other kings, but mainly Louis XVIII, I guess, who once said, If you give me good politics, I will give you good finance.
Well, thank you. That was totally fascinating and very stimulating. And I'm sure there are many questions in the audience. While waiting for those to appear, because it always takes a while to kind of think about it, I just wondered if you could say a little bit more about this balance between fiscal responsibility and the need to increase demand and GDP, because they seem often to be in tension with one another, and especially in the Eurozone, where there are limits on the percent of debt that governments can legally have. So how do you square the circle, as we say?
Well, this has been a discussion since the start, and the fiscal rules. I mean, the Stability and Growth Pact has been reviewed, revamped a number of times.
Right.
I mean, every 5 years you have a new version, which also tells you that the previous version hasn't worked. But I would say that the crisis has radically changed the picture, because it has led to a jump in the level of debt, which makes it very difficult for a number of countries to use debt as a way to create growth. You would need, so there are different views on this, but when your debt is, and there is no single number because it entirely depends on the situation of the country, but when your debt is above 100% of GDP and rising, it's very difficult to explain that you would undertake massive investment projects without any cost in terms of the cost of your debt, in terms of market confidence, in terms of market access. So my take in that discussion, but it's a very controversial discussion in Europe, as you know. My take is that very few countries have that kind of fiscal space. Germany has it, maybe a few others. But what I wanted to, I don't think that France has it. I don't think that Italy has it. Also, from my experience in my previous life as Treasury official, I had to pass a judgment on many public investment projects and compute the social cost and social return of the projects. And nearly all of them had negative social return, because that was about building new high-speed train lines, building new highways in a country where you already have many high-speed lines and many highways. It's very difficult to identify a project, a physical project with a positive social return. So you've got to. So my conclusion would be that if there is scope to, there is a need for more public investment, but it has to be mainly immaterial investment. It has to be in education. It has to be in universities, and that's much more difficult to do.
Yeah.
And it has to start with the European budget. So there is a paradox here that the discussion is entirely focused on fiscal stimulus at national level, while we have a European budget, the structure of which is clearly doesn't make sense from an economic standpoint, because it's a legacy of the past, and it's very rigid, and we know the political economy of it, but it's not fit for what would be needed in the European economy today. So the discussion also has to be about European instruments and European investment. That is starting. We have the Juncker plan, which is, I think, a step in the right direction, but it's still limited.
Thank you. Chris Dessan.
So I found it a fascinating talk, and
Oh, sorry. Yes, please speak into the
I share
microphone.
many of your intuitions, I think. I mean, part of what was most interesting to me is you can think of credit. You can think of credit as something that we gain by insulating an actor from politics, or you can think of credit as something that we gain by creating decisions that are consonant with political decision-making, right, that are based on sound decision-making. And that, of course, leads to the question of sovereign safe assets, whether money or debt. So and it takes us to exactly the monetary fiscal link. So I'm interested in going there. In particular, so I work on money as a legal institution. It's clearly the ultimate safe asset, and it is the unit of account because it's a debt set off against incoming future political obligations, right, the tax obligation, so that you have, by definition, a unit that will be paid off. In other words, it's inherently a monetary value because it's tied to a fiscal obligation. So the experiment of the EU of trying to distill out, abstract out the fiscal, divide fiscal authorities from monetary authorities is endlessly fascinating. In the end, I mean, where you ended with the possibility of trying to create some more fiscal backing for sovereign debt and the euro indirectly, and it set me to thinking about how the United States got there. One of the ways that the way the United States got there, when I think back, is war, is incredibly convulsive war, the Civil War, most obviously, and then World War I right after the establishment of the Fed, and World War II right after the Great Depression. And the Civil War was really the moment when the United States issued huge amounts of sovereign debt. So it's sobering. It's sobering that an experience of national unity came out of that amount of events that really changed national identity in a way that I just don't see happening in Europe. So in particular, state sovereignty is much weaker than I think the European nation sovereignty still is. So I guess this is a question, just asking you to reflect. Is there, if that's the American story, is there some way to get to realign ideas of national unity that would create more European identity that would back this kind of fiscal union?
Yeah, I mean that's a very, very deep question. I very much hope that we can do it without a civil war. That's the first answer. And maybe a first answer is that it's absolutely necessary to use the U.S. experience as a reference, as a benchmark. Now, obviously, what we're doing, what we're trying to do to achieve in Europe, what we will achieve in the future has to be different. So there is a limit to the comparisons. One reason being exactly the one you gave, that Europe is a federation of nation states, as we know. So there is a sense of national sovereignty which nobody wants to suppress. So it cannot be part of the project to suppress national sovereignty. There has to be some of this national sovereignty is shared. Obviously monetary sovereignty, but also in many aspects of trade and competition and economic regulation, that is shared. And the way I would describe the stake from the perspective of the central bank is that we want to be sure that the amount of sovereignty that is shared is we want to see as much sovereignty shared as will be necessary for the single currency to work, and we're not yet there. We're not yet there. For instance, it was quite obvious for many economists that running a single currency would require banking union, that it just wasn't possible to have a single currency with 19 different banking regulations, because money is created by banks. So M0, to use economic terms, M0 is single, but M1 was not single, because banks were regulated in different ways. That's not possible. But we've taken that step now. So it will take a long time to fully do it, but that has been politically understood. So it's a process whereby gradually you align the perimeter of shared sovereignty on what is exactly needed to have a single currency. But and initially there was a misalignment, and there is still a misalignment. So that's how I would see the process. So as I said, I very much hope that there will be no civil war, but there are also some possible comparisons. We've been through a crisis, which has been the deepest crisis in Europe since the 1930s, clearly, which still leaves scars in our societies. I mean, youth unemployment is incredibly high. The losses of jobs are partly permanent. The potential growth, long-term growth in Europe is permanently lower than it was before the crisis. So that's not a war, but it's as severe as a war from an economic perspective, and that also has created a sense of commonality. That's what made banking union possible, and that may be what will make at some point fiscal union possible. So we can do it without a war, but building on the lessons of this crisis.
Thank you. I have Art Goldhammer next.
Thank you for your talk. I'm going to ask a rude question, so I beg your pardon in advance. My rude question has to do with the competing narratives of the role of the central bank, to which Mary alluded in her introduction, and the notion that there are heroes and villains. Recently, there were 3 books published in the United States by Joe Stiglitz, Yanis Varoufakis, and James Galbraith, all of which cast the European Central Bank in the role of a villain. Not the worst villain. For them, the worst villains were the German government, the IMF. But still, the ECB was, for them, a villain precisely because of the role that it played in obtaining what you indicated Baron Louis suggested was necessary for good finance, and that was good politics. Their accusation is that in order to get the politics that financiers considered to be good, the central bank interfered in the democratic process, particularly during the Greek crisis. So I wonder what your view of that account of the role of the central bank is. Do you reject it outright, or do you think there's any validity to it whatsoever?
Yeah, well, that's not a rude question, because the question is everywhere. So we have to answer it, and we have to ask it to ourselves. And maybe I may call as witness Lucas, who's been part of that conversation on different sides, by the way, also on the as Prime Minister of Greece. But my answer would be that. There is a mix in all these narratives and these books. There is a mix of different things. Some of them are, I think, very relevant and have to be reflected on because we have to learn from the lessons from the crisis. So there are good points being made on some of the mistakes made not only by the ECB, collectively by the European decision-making bodies in the crisis. Or some things which we could have done differently. So, for instance, one typical story which you haven't mentioned is Ireland and the bailout of partial bailout of Irish banks, or the refusal to bail in senior bondholders in Ireland. Here, I think we've moved on. I don't think it makes a lot of sense to reinterpret history. Because I wasn't there. The world was different. There was an international consensus that banks had to be bailed out. That was G7 policy, G20 policy. The U.S. Treasury insisted on it. That banks had to be bailed out for the sake of financial stability. So that was the international consensus. But as a fact, it clearly led to a burden sharing, which was very much on the shoulders of Irish taxpayers in that case. And we moved on. So now we've moved, in the case of banks, we moved from bailout to bail-in. And if such a case would happen today, bondholders would have to pay without debt. Also in the case of Greece, we've also moved on, and that's the whole topic of the discussion today is about debt and default. Initially, there was no acceptation that the Greek debt could be restructured, also for good reasons, because of contagion and the lack of European instruments to protect the other countries, initially in 2010, which we now have. And again, we've moved on, and the Greek debt has been restructured. It has been restructured twice, actually. Private debt has been restructured, has been cut. Public debt, EFSF exposure also has been cut by restructuring maturities and interest rates. And now there is a discussion on a third debt relief for Greece, which I very much hope will take place. I mean, the ECB has been public that we have serious concern over the sustainability of Greek debt, and the discussion on debt relief is warranted. So there are issues where we have to learn, and we are moving on. Now, on the political aspect, which is the heart of your question, I have a fundamental disagreement with say, Yanis Varoufakis on this, and which I have discussed with him many times. What the ECB has done is a reflection of the political consensus, political decisions taken by elected policymakers, which were European finance ministers, which you may dislike, and certainly he dislikes these decisions very much. But if you take the example of Greece last year, for instance, Greece in 2015, the ECB has taken stock of decisions taken by European finance ministers. For instance, we've continued to provide liquidity to Greek banks. The amount of liquidity provided to Greece has increased from, say, around 45 billion euros in December 14, before the election, to 130 billion euros in July at the time of the referendum. So it's very difficult to argue that the ECB did not support the Greek economy. We've provided an enormous lot of liquidity to Greece. We don't take particular pride. That's just our job as a central bank. So that's just what we had to do. But it came with limitations. For instance, we've limited the amount of liquidity which Greek banks could lend to the Greek government. Mm-hmm. So we've lent them money under the condition that money would not be relent to the government, because that would, in our view, have breached the prohibition of monetary financing. So one political way to put it, because you're asking a political question, so let me phrase it in political terms. How could the ECB have decided to extend a bridge loan to Greece when European finance ministers had decided not to do it? They had discussed it and they had decided not to do it. If we had decided to do it, that would have been a political act.
All right, I have Peter Hall next, and then maybe one more question after. Okay, and yes.
If Lucas could say a word.
Oh, I'm sorry, and yes. Okay, three more questions, Peter.
I'll ask my question quickly. Thank you for a very, very elegant and informative talk. The content to words ratio was very high, and I think we all appreciate that. The account you gave of money, which emphasizes it as a store of value, a medium of exchange, and a unit of account, is of course incontrovertible, but could also in some sense have been given in the 1920s and is in some ways pre-Keynesian. So I wonder what your analysis would look like if you added in monetary policy. Is there not a role for that? And to make that even a little more difficult, don't you think there might be a role for inflation? Is there a role for inflation in this story? What should we add a postscript to your account?
Yeah. Well, the whole conception of monetary policy that we have in not only in Europe, by the way. I don't think the U.S. conception is very different. I mean, the mandate is legally different, but the practice is not that different. That is all very much pre-Keynesian. I agree with that. Monetary policy has a price stability objective, and stabilization has to be done by governments. And that was very much the premise of the whole discussion. Of course, in practice, it's very different, because whatever you do to bring inflation back to your objective also stimulates the economy. So in practice, it's an important discussion in theory. I don't think it's that important in practice, because most of the shocks we face are shocks where we have to react by stimulating employment, stimulating GDP, which is very much a Keynesian identical, at least empirically identical to Keynesian policies. And that's what we've done through the crisis. What we're doing today, which is zero rates or negative rates, QE, that is, do we do it because we want inflation to go back towards 2%? And the way it works is by stimulating aggregate demand. So it can be a passionate discussion in theory. In practice, I don't see much of a difference. But maybe I'm too much of a pragmatic here.
Tony.
In a way, I guess my question. My question reverts to the first question and your response to it. I think in general, you've made the case that central fiscal capacity of some sort is necessary to enable debt to perform a stabilization function. And in a way, you need the central fiscal capacity to de-link the possibility of that function from the fiscal situation in the sub-sovereign units. Okay, and the prospect that you set forth about achieving that or building that was that some commonality could be found which would lead to it, built perhaps on some common experience. But if we look at the actual politics around these issues in Europe now, the experience of the crisis is very divergent. And the country that has experienced it least has gotten through it so better than anybody else. Any other countries, of course, Germany. And the chances, and I really wonder, is how you would ever get Germany to agree to create a central capacity in which debt would function as would be able to perform the stabilization function, when particularly the black zero is the dominant view in Germany. So that if you would have to de-link the central capacity from German policy and the conditions in the German economy and the diverse conditions elsewhere. But I don't see the way in which this could happen.
So let me answer shortly. I'm generally less pessimistic than you are, because if you look at what has been the response, the European response to the crisis since 2010, we've created the ESM, which is 500 billion euros, which is a common an element of a common fiscal capacity in a limited way, conditional, etc. But it's a joint fiscal instrument with limitations, as I've said, but still. And it works. It has been used for Portugal, for Ireland, for Greece, for Cyprus, for Spain. We've created the Single Resolution Fund for European banks. So it's much smaller. It's 60 billion euros. But it's also an element of a common fiscal capacity, also with limitations. So experience shows that whenever Europe is really facing the urgent need of it, and in a crisis situation, they walk the last mile. That's what we've seen, always. So I'm not saying that we want to see another crisis to take the next step, but there is a sense that when it's needed for the survival of the project, then it is done. It is done. That's what we've seen through this crisis. So of course, this is countered by national narratives, as you've said, not only in Germany, everywhere, also in France, in Italy. So there are different narratives conflicting. And there is a risk that national politics are focused on their national narrative and lose sight of the common interest. That's the essential, the basic existential issues that we are facing as a European institution. But here we need European institutions, the Commission, the ECB, to remind them that they have a single currency. So you cannot free ride on what is a common project. And at some point there has to be a sense of political compromise. Otherwise, it doesn't work. But again, whenever it was vitally needed, we've seen it.
Okay, final question here. Yes.
First of all, let me thank you also for a very insightful and valuable presentation. I would like to make two remarks and raise one question. The first remark relates to your point concerning the criticism that has been advanced by some economists, particularly against the ECB. And in my view, this criticism is really not warranted. And I think it partly reflects a lack of knowledge of the institutional framework within which the European Union and the ECB operates. I fully share the points that were made by Benoit in response to your question, so there's no need to repeat them. But let me just add, in general, that as Benoit said, the fundamental decisions were taken by finance ministers and the European Commission and the IMF, and then the actions of the ECB were appropriate in the sense also that they met the constraints imposed by the treaty, as well as the ECB's rules concerning the provision of liquidity. So my own assessment is that actually the ECB was very supportive of the stabilization of the Greek economy over the last 4 or 5 years. Now, my second point is really a remark on the issue you raised concerning the role of the central bank in being the provider of safety assets. I think, as you said, I agree with this, operationally is feasible, but I have doubts about the desirability because I think, in general, it can create difficult conflicts and potential conflicts and trade-offs for the central bank between attaining the objective of price stability, of keeping inflation low, stabilizing real output, and meeting the demand for safe assets. What it requires for the central bank is that both it controls the overall balance sheet of the bank, but also the composition of the balance sheet. Now, under certain circumstances, this may be feasible and appropriate, but I think in general, this may not be the case, and it may create problems. And an associated side remark, you did mention correctly at the beginning that if one consolidates the balance sheet of the bank and the treasury, one can eliminate the credit risk to the creditors. But this may imply an inflation risk for the society as a whole. So this has to be taken into account as the other side of a coin for performing this role. Now, the last remark and question concerns the choice. Sorry to be a bit long, but I did not intend to give an answer to the question that you raised. The choice between alternative models for providing safe assets. I think looking over the longer term in my mind, it's fairly clear that the performance of the Eurozone, both with regard to growth and stability, will require, in the longer term, achieving a higher degree of fiscal integration and a greater mutualization of risks. This, in my view, conceptually clear fact, however, looks rather remote at present. Mm-hmm. So the one issue is, the one observation, rather, is in choosing among alternative models for the provision of safe and less safe, risky bonds. How do we relate this to the prerequisite of, at the same time, neutralizing risks and increasing the degree of fiscal integration? And the question now is that since this is, I think it's not an easy question, considering the prospects over the medium term, let's say for 1 or 2 years, is there some concern that the difficulties that we face on the road ahead may overburden the conduct of monetary policy by the ECB? Given that fiscal policy at the euro area level may not be able to play the role conceptually it should play, can this imply that, I think the term is overburdened, but alternatively you could say may influence the effectiveness of the ECB monetary policy and accumulate certain risks that are unintended, for sure? Thank you.
Before you answer that question, let's just take one last question from my co-organizer, Emmanuel Boujou. No? Yeah, okay. Fine, okay. And go ahead then, sorry.
Yeah. No, I share some of the concerns or reservations you express on central banks doing too much, including providing safe assets that are not provided elsewhere. There is always lots of expectations toward the central bank. People would like us to do everything, or nothing. So that's a fundamental contradiction that we are torn between these different expectations, and that's why that's exactly why we're independent, because we want to be able to resist both sides, by the way. And we're happy to take the blame. I mean, that's part of being independent, that you have to take the blame, and that's fine. Provided that you explain, that you're able to explain what you're doing. So yeah, there is a risk that we would be asked to do too much, which would create an issue for monetary policy. I agree. And in that, there are lots of technical dimensions in the discussion on safe assets. For instance, what we've been doing as part of our monetary policy has been to issue a lot of short-term money. We have more than €1 trillion of central bank reserves today, which is a lot. And at the same time, we've been withdrawing long-term assets from the market by buying French bonds, German bonds, Italian bonds. So we've acted on the composition of safe assets by shortening the duration of the safe assets. So if we would like to be nice, quote unquote, and provide the safe assets that the market would need, we would need to issue long-term liquidity, not short-term liquidity. So we would need, for instance, to issue ECB bonds, which is something we can legally do, but we've never done. But does it make sense from a monetary policy standpoint? I'm not sure. And at the end, what will prevail is the monetary policy objective. So at some point, there can be a contradiction. I agree with that. On your second question, which is, are we overburdened? I wouldn't phrase it that way. Clearly, the whole setup is not very effective. So the ECB clearly has had to do more than what we would have otherwise done if fiscal policy had been better, if structural policies had been better, and we have to fill a gap. I don't draw the conclusion that we would have to do less, because we still have a mandate which is given to us by the European people, which is bringing inflation back to 2%. 2% is the way we see it, but it's price stability. So we'll do it. So I agree with the premises that there is some dominance of lack of fiscal policy or lack of structural policy on monetary policy. This is not an excuse. This cannot be an excuse for us to do less. So, for instance, the whole notion that is popular in some places in Europe that monetary policy should do less in order to provide the right incentives to governments, for me, is in contradiction with our mandate and in contradiction with the treaties, and with it's in contradiction with Ordnungspolitik, if you want to put it that way.
Should monetary policy do more? I agree with you. It shouldn't do that. But, in case the economic developments are not as we would like.
No, but we'll do what is appropriate under our mandate, which is an inflation mandate, right? If we would have to do more because we don't see inflation coming back to 2% in a sustainable way, we would do more. That's not the discussion today, to be clear. Also for the press people here somewhere, that's not the discussion we're having today, right? But we do what we have to do, but within our mandate. Yeah.
Any last thoughts, Emmanuel?
No, yeah, it was just a simple remark. About the fact that when we decide to call a safe debt as blue debt and risky as red, it's kind of a U.S. good narrative. Yeah, it's kind of American narrative. I think. So
it doesn't at all come from me. It comes from a paper by Jacques Delplat and von Weizsäcker, which dates back from 2010. So yeah. Ask them.
All right. Well, on that
something.
Note of the transfer mechanism in the U.S. too, from blue to red and vice versa. Anyway,
thank you
very much. That was incredibly stimulating. Thank you so much.
Very good and risky.